We are waiting for all our guests to join in. The event is about to begin shortly. Thank you again for your patience, everyone.
Hello, everyone. My name is Nosheen Zainab, and I would like to welcome you to another edition of KiwiTech's exclusive Venture Capital panel. We appreciate all your support for this event. Today, we have a fantastic panel discussion on the advice that investors are giving to existing portfolio companies, followed by 4 premium startup presentations. I am joined by my colleague Karishma Tirathani, and the two of us will serve as the moderators for today's event. I am super excited to introduce KiwiTech, a one-of-a-kind innovation ecosystem that's home to 500 plus portfolio startups and 300 plus mentors, all committed to supporting innovators globally. It all began in 2009 when a team of seasoned entrepreneurs who had previously built and scaled a publishing services company for a 9-digit exit decided to start another company to empower startups with innovations. Without further ado, I would now like to invite our panel moderator, Ben, Executive Director at VisionTech Partners, to start with the panel discussion.
Thanks, Nosheen. Thanks for everything that you guys are doing at KiwiTech. My name is Ben Pigeon. I'm the Executive Director at VisionTech Partners. We are a Midwest investor angel group that has a pass-the-hat business model for gathering funds. But we do not only invest in Midwest, we'll invest across the country. Tend to gravitate towards items in the life science, B2B SaaS, and hard tech areas. And our average first check size is around $185,000. But we will follow on, and I think our all-in average is just shy of $400,000. So that's us, VisionTech Angels. I'm joined by Zach and Jenna, who I'd like to open up with a brief introduction on you guys. What's your background? How long have you been kind of in the early stage, or what stage of investing do you do? And then since we're talking about advice, maybe how many boards you might be on or how many board observers you're on.
Yeah, so hi, everybody. I'm Jenna. I'm an investor at Joyon's Partners. We're an early stage fund. We invest all over the US, UK, and Europe. Our investment thesis is investing in moments of joy. So that can mean a wide range of things, but usually it's anything that falls between consumer, healthcare, as well as wellness. So more specifically, beauty, CPG, food, beverage, sustainable materials, sustainable fashion. And on the healthcare side of things, a lot of women's health and wellness, as well as health tech and life sciences too. Me in particular, I focus a lot of my time investing in companies in the consumer space, namely beauty, CPG, food, bev, and I help oversee a lot of the femtech investments as well. So we'll do anything from pre-seed to Series A, and then we have a growth stage fund that looks at rounds past that. Yeah, in terms of being on board, so I'm not on any boards. So the way that our fund works is that we write a lot of checks, and we typically don't take board seats, and we don't lead rounds. So given that, it doesn't really. We have a couple folks who are board observers, but it's a lot of people to oversee in the portfolio, so it doesn't really make sense for us to do that. Yeah.
Gotcha. Zach.
Hi, so I'm Zach Lowe. I'm the senior VC scout at Fundin. It is I guess you could call it a VC scout firm or VC scout agency. We represent about 800 VC firms, from micro funds all the way through to top tier 1 funds across the US, UK, and Europe, if you consider Brexit. And we mainly work with startups between the seed and Series B stages, looking to raise anywhere between 1 and 30 million USD. And the role that we play is not so much on the investment transaction itself, but it's more so to do with getting founders ready to raise institutional investment. Discussing what exactly an institutional investor is looking for, and getting them ready for that. The partnerships that we have with our VCs, it's not a network registration. It is very much an active partnership that we have with them. So that list of 800 is not an ever-growing list. It's a list that we actually try and reduce whenever we can, and highly qualify those investors to be active, but also to ensure that we really understand the mandate that they have for their particular fund, beyond just sector and stage. We want to understand what the real vision is behind that, and so we do our best to understand what they want to invest into, and also, as we prepare startups to raise investment, putting that investor hat on. Within our team, we do have a principal VC, former principal VC at Roivant Ventures, and a few analysts and operators that are exited founders themselves. And so they all come from very experienced positions within sitting on a board, and that's kind of what we do.
Awesome. Thank you for those quick introductions. So I think what we're going to step into next is the topic today is really what are investors giving in terms of advice to their startups that they funded. So if we could probably set the stage a little bit for this conversation, at least initially, where it's a seed stage, maybe early series A stage company, and they've just successfully raised $1 million or $1.5 million, maybe $2 million, maybe more. And the celebrations are aside because it took 6 months to do that fundraising, and the champagne has lost its bubble. So now it's time to create some value. What are some of the pieces of advice in terms of themes that you see being given to these founders, CEOs?
Yeah, I'm happy to speak first, and I'll definitely just asterisk all my answers with the fact that I speak mostly to consumer folks. So it's probably very different from, speaking to the life science people or people who are in tech. But definitely, I think overall right now we're seeing a very tumultuous time, especially in the fundraising market. People are having difficulty filling their rounds. People are having difficulty stretching their cash out. So I think definitely if you're able to stretch your cash out in whatever way possible, that's obviously something that we highly encourage to all our founders. And I guess other than that, and other than considering market sensitivity right now, thinking about how you're moving forward in terms of press, in terms of your relationship with the community that you've generated. I think it really depends on what stage you're at, whether that the round is dedicated towards developing your product, whether it's for generating some kind of traction, whether it's for reaching your audience, whatever stage you're at, really just trying to nail down the milestones that you've been setting forth to raise your cash towards, and working towards that those milestones, I think is key. Something that I'm advising a lot of the founders that I meet right now, especially with the conditions of the market, it's to raise incrementally, build incrementally, set out those milestones when you're raising, raise the minimum amount of cash you need to hit that milestone, and then do it again. So right now it's all about this incremental step-by-step fundraising that I've been seeing.
Jenna, I want to echo this. Your comments are not at all different than some of the advice that I hear given to life science stuff. Stretch the cash out as long as you can and make sure that you're hitting those milestones. That resonates really, really well with me. Thank you for that. Zach, do you have anything you want to add?
Just want to echo what Jenna said, and yourself as well, Ben. 100%. Things are not as they were 6-12 months ago. Even just in the last couple of weeks, things are always shifting and getting harder. An analogy that I've heard being used is trimming the fat on the unicorn that you're trying to build. So yeah, you need to really stretch things out as much as you can and make those, set those milestones towards profitability as much as you can before, throwing in another massive raise. Something that we're advising a lot of the startups is to try and not to create this lovely rainbows and butterflies type view on how amazing their startup is and how amazing it will be no matter what happens in the world. I think it's important to lean into the fact that we are in a recession, that things are different, and what will they do to stand out regardless of this. I think it's a sign of a good founder to really understand that that they can't just bluff their way through market conditions, but they have to be able to navigate it. They have to be a good manager, a good leader, and that obviously means that they need to navigate the fundraising space as well.
Yeah, I really, really, really agree with what you said. I think the number one quality that really stands out to me as what sets a founder apart from the others is honesty. Honesty with themselves, honesty with others, with the reality that they're facing. Right now is a very difficult time. I see founders struggling right now, whether it be raising, whether it be selling, and being able to convey that honesty and ask for help when you need it. So important.
So, I mean, if we can peel back the layer of the onion here a little bit and say, like, how do you really extend the runway? What are some areas where you can trim the fat from the unicorn if you can? What are some specific action items? So this is one of the trademarks that I have is I like to give actionable items that people can look at. And so I'll start off with one that's really uncomfortable. I would say the first thing that needs to be identified in a board budget is salaries, and there needs to be a compensation committee. And you need to be talking about how much the CEO is compensated and whether or not they're hitting their milestones and how well those milestones are defined, whether there were the right milestones to be defined. And, are those milestones the ones that create value? So to me, that's one that we tend to evaluate quite a bit when we get into due diligence is the compensation package for the managers that are creating the value. And that kind of comes in with, it's not just salary as terms of compensation, but there's also non-monetary kind of value too. There's equity in the company. There's also maybe time off or other perks. So all of those cost money, and they should be, every moment, every ounce of that precious resource of capital should be going towards creating value. So how do you create that value? How do you trim the fat?
Maybe I'll go first this time. I'll take turns. So a company that I recently came across really answers that question around how much should someone get paid in terms of equity, benefits, etc. It's actually a French-based startup called Figures, Figures.hr, I think it is. And they built a whole data set around not just how do you set compensation rules for various levels within the business, but also how do you retain really good talent. I hope no one here has worked for Facebook or Google, any of those kind of companies, but typically the idea is that we hear companies wanting to hire software developers, and they may have a really strong background and they expect the same salaries and same benefits as they would at some of these massive companies in a very small and young startup. And it's just not appropriate at that time, at least in my opinion. So looking at the data, not just from let me pay everyone as little as possible, but also looking at where can I source talent from around the world. We are living in a world where we can use technology to broaden the reaches of our offices. And so in the UK, it's much more expensive than other countries around the world. I know some great startups that we're working with that are sourcing talent from elsewhere, from abroad. And it's not about getting cheap talent. It's just about being creative with how you deploy those funds, being creative with getting really good teams together in a creative way. So I would, echo that, be careful how you're compensating, be fair and be able to retain that talent, but also be creative with where you're sourcing that from.
Yeah, I definitely agree. I literally had a conversation today with a founder who was trying to figure out ways to trim the fat. And of course, this founder, a lot of the folks that I work with are very early stage. They're not even taking any salary. All the dollars are going right into the business. But other ways you can do it, it's definitely, I think, the number one lever I see being pulled back right now is marketing. I think we're in this day and age where there's a smarter way to go about marketing, whether it be cultivating your own community of people who really are devotees of the business that you're making, and will help you make user generated content, or even being able to negotiate better ways of dealing with your rent. I see founders all the time cutting deals with real estate in order to get cheaper rates. So it's really about this like hustling mindset of trying to be a good negotiator, trying to have partnerships and collaboration that allows you to cut a lot of costs while working in collaboration with others, I think is another really smart way. So overall, I think salary, marketing, rent, fixed income, fixed costs. And if you're manufacturing, definitely taking a very close look at your supply chain and seeing what you can scale back. Something that I'm seeing a lot of the founders having to contest with right now is balancing whether or not they want to continue investing into R&D and future product, future innovation, over being able to just sustain the momentum that they have right now. And I think, obviously, we're all speaking in hypotheticals, and it really totally depends on the business that you're running. But having to understand what works for you and whether it makes more sense to be investing into your innovation, into creating and building, versus tending to the community that you've already built and keeping that momentum going. Having to really understand what is more important and will, get you further along is really, really crucial when money is running out.
Mm-hmm.
Something I just wanted to add to that as well is, the importance of getting a strategic investor on board is of course the investment doesn't just mean capital, but it also means their network and their resources, their time. And so it's not just an investor turning to their portfolio company saying, hey, how are you going to get this right? How are you going to, pull a fast one and make the money go further, but also for the founders to ask those important questions to the investors and see, what resources can they provide now that things are tighter. New investment doesn't necessarily get put on the table. A new investment round doesn't necessarily make sense. But what does the existing shareholder or the existing cap table have to offer to help them through this time?
Yeah, I'd have to agree with that. There's a lot of different ways that investors usually like to lean into their portfolio companies where they're trying to make sure that they're as a successful outcome, primarily because we want all of our portfolio companies to succeed. I mean, we've given them precious capital to make sure that we see an idea come to fruition and create that value. So I'd like your thoughts on company updates. And this kind of ties into, maintaining that kind of relationship with that source of capital, right? So I think we've all been in situations where we've invested in a company or have seen an investment go out the door, and 6 months later, with no updates, no monthly updates, are coming back saying we need more capital. We burned through everything that you gave us, or maybe 12 months later, 18 months later. And you as an investor, it's really easy to see when stuff isn't going well. It's also really easy to see when stuff is going great and milestones are getting hit. But there's this kind of large area where I would say maybe 3 standard deviations are the majority of the portfolio companies are, for us at least, right in the middle where it's a gray area. And, some stuff has been proven out from the hypothesis, but not all of it. And so what's your advice to those companies that have kind of in this, dead man zone of not really reaching an inflection point, but some of the stuff is testing out.
Yeah, I think I just wanted to circle back to something that Zach said. Definitely having a relationship with your investors are so important. I feel like your investors are probably going to be the most underutilized source of resources for a lot of these founders. I just feel like, as you said, investors are more than just a name on the cap table, and just more than a source of cash. There's a lot of resources that are available to you through them. And I feel like when it comes to updates, it's also harming yourself by not keeping that relationship going and updating your investors and having these check-in calls. With my portfolio companies, I'm definitely always on top of checking in with them. A phone call doesn't hurt now and again. And this kind of brings us back to what I said earlier about honesty. I think even before investing, from my point of view, it's really important that I know that the founder is honest and is going to, nurture this beautiful relationship that we're going to have together for the whatever amount of years to come. And so I think having that quality from the get-go is just so important, because it really, you've shot yourself in the foot once you've realized down the line that that the updates aren't coming because all the money's burnt out. You really want to know that the relationship is healthy and very transparent. Overall, bottom line is there really should be no fear in updating, whether it be good, whether it be bad, whether it be mediocre. I think just having that communication is so important.
I won't add much more. That's spot on. Exactly. I would be thinking about this. Again, that honesty aspect, even if things are not going as planned, be upfront about that. Again, these investors should be in a position where, they're experienced founders themselves most of the time, or they've been down this road themselves in the past, or been close to it enough to provide some advice and some insight and some introductions that can open up more doors. And it's often just an outsider's perspective that you need to make those changes. So yeah, 100% just be honest with those updates and keep them going.
Yeah, I'll add in, I don't think it needs to be real complicated either. I mean, a lot of the advice that I end up giving our startups is that your relationship with your investor base is kind of like a marketing campaign. If you think about what it takes to sell your product, in this case, if your target audience is your investor base, your product is your company, and you've got to maintain that relationship. And so, a drip campaign of very simple format of, here's what's worked, this is what we accomplished in the last 90 days, this is what didn't work, and this is what we learned, and then this is what we're going to be working on for the next 30 days. And that's 3 paragraphs that you could send once a month. I'd hope that doesn't take you more than 30 minutes to draft out. But there was one company that would do this with us consistently. I could set my clock to it. At the midnight on the last day of the month, I would get an update from him consistently. And we wrote 3 checks to him. So it works. It helps soften the blow when you are going to come back asking for funding. So keep it simple. It is one of those things where it's really hard to keep it simple. But it's so easy to do that I see a lot of folks kind of forget about that aspect of it when they're trying to build out something of value.
And I'll add one last thing to that. Just at the bottom, have your asks too. Our
Sure.
sort of come to us asking for help. They say, can you introduce us to Walmart? Can you help us hire a new marketing manager? Easy things. And we're happy to send that out and get you the help you need. So.
Yeah, absolutely. I do want to kind of open it up for questions. Maybe if anybody has a question that's in the panel, I know we've got 65 people kind of in participating here, but if you have a question that you want to ask anybody, type it in the Q&A or the chat. But, I think another thing, just out of curiosity, you fund a company, you write a check, And there's a thesis around customer acquisition, right? Jenna, if you're in consumer product goods, you are closely looking at your cost of acquisition, how much you're spending on marketing versus, you know, the dollars going out, coming in. How often should everybody be reviewing those budgets and testing those cohorts?
I would say, I mean, if you were a monster, you're doing it every week.
Yeah.
And then some. And I've seen some of the most amazing marketing reports that I've gotten are there's this one company that I was looking at, and they're so fantastic. They've done this cohort analysis where they've tracked literally every single person who has purchased from them from the moment they launched to now. And they have a giant Excel sheet of the number of times they went and bought again. So obviously you don't need to be doing something that comprehensive and detailed, but having those numbers update on even like a monthly basis, I think is very, very important, because it's going to fluctuate depending on what levers you pull, you know? And I think it is so important to telling the story of your business. And I feel like if you're in consumer goods, you know that. I'm sure your investors are always like, what's your CAC? What's your LTV?
Well, yeah. What's your CAC? What's your LTV? What does, you know, I think something else that may be a little bit of a misnomer, Zach, I don't want to steal any of your thunder here, give you a chance, but you know, I think the assumption that your customer cohort is a static response to your marketing message can really, as you try to scale up, that target will shift on you, and you need to be constantly tweaking what that branding and that messaging looks like, I think, and always evaluating that just because it worked a month ago or 2 months ago doesn't mean that it's going to work now on a go forward basis, primarily because the economy is changing. There are a lot of different pressures. There's fog in the air. I personally think fog's going to create some opportunity, create some value for people, because it's going to kind of mask the true value of some of these companies. But Zach, you want to add anything?
More so to your point, you know, the fact that these things are always changing. You can have, you know, you may be the greatest founder out there with the greatest team and built the greatest tech, and that's great, but it's not going to go anywhere without the customers. And any product, not just technology or software itself, but any product out there. And so the focus really has to be that if you as a team, if you as a founder does not have an absolute, you know, 2020 vision on who your customer is, what it takes to engage them, how they are moving, how you should be moving and following along with them, that's really not going to go anywhere. So you really need to focus on that. And CAC is one of those things. LTV is one of those things. There's so many things that touch on that, marketing itself as well. But yeah, you really have to focus on that and not get too obsessed with, oh my goodness, we just launched a new feature. That feature may just not be what the customer needs.
I think something I'll add really quickly to that is, I feel like, you know, we can get lost in the numbers all day. But I feel like there's also a very important intangible aspect of this, which is the community that you've cultivated. So you have to have a very strong understanding of who your customers are and who your diehard customers are, and who are your customers that are going to go and preach to their friends or their colleagues about your product. So being able to make that community, sometimes it's impossible to quantify that in numbers. You can say, you don't really know how big that is. You don't really know how hard they ride for you. But having built that community, whether it be through brand, through your messaging, through your product, through your technology, what have you, that's also very equally as important, and something that I look for beyond just the numbers of CAC and LTV and whatnot.
Yep. We have about 5 minutes left. I know there's some questions that came in. I think if we can, try to rapid fire through some of this stuff. The first question in the chat was SBA. I have a banking background, so I'll take that real quick. SBA is a great source of capital, but they're going to require you to put a collateral. Like you're going to promise your house as collateral and they're going to take a first or second lien on your house. So, generally bank loans are going to be looking for profitability. And I would say at a lot of the seed and Series A stage, you're just not going to have the financial metrics that a traditional bank would lend to you. If you have a bank that's willing to do it, take it all day long. It's non-dilutive. But I think there's going to be stuff that you're going to trade off on that are really kind of nuanced. It's just a different type of capital. All right, the next one came in regarding updates. Are investors looking for updates outside of the board meetings that are set quarterly, especially in drug development, where updates may not be available or as often as other types of ventures? I don't think it hurts. It's a piece of communication, and it literally is a moment that you're saying, I'm thinking of you. And I'm spending your capital wisely, and I care about how you think. So this is what happened in the last 30 days. It may be, since drug discovery takes a long time to get through testing, the update may be there is no update, and that's okay. Either one, all in the above. Jenna or Zach, do you guys want to jump in on the life science question there, or should we move on?
Yeah, I just want to say that they should never be wondering about what's happening with their investment. They should always know what's happening. And if nothing's happening, then they know there's nothing happening.
Yeah.
Well, actually, sorry, Jenna, go ahead.
Oh no, I was just going to say always better to have it on paper so that everyone can see it.
Yeah.
Not a
Yeah.
secret.
So I think you're leaving people, if you don't answer the question, you're leaving people to answer it for themselves. And the assumption automatically jumps to, if I'm not getting updates, then it must be going poorly. I'm just going to make that assumption. And because bad news is really difficult to share. So that's the comment that I've heard from my investors a lot. Another question came in: high interest financial companies, 19-month terms for 100,000 with 115 payback offer, good or bad? I don't know. I mean, I need more context. Zach or Jenna, do you want to jump in?
I don't know. I can't even the question. So
High
I don't
level.
remember the numbers you said.
Yeah. All right.
No, that's definitely too high level. We need more information on that.
Yeah, a little bit more context. All right, Jerry is asking a question. In these difficult times, are there certain types of companies that have greater chance of getting funded? For example, product company with clients versus technology company with great tech, but still pre-revenue mode. I'll kick that to you. I can jump in though too.
I was reading that question before. For us, we seeing the companies that are getting funded as being real problems being solved. Again, you may be a great developer, great ideas, but is it really a problem that's out there, or is it just a problem that you've created and trying to solve? So it really has to be a real problem. And in the pitch deck and in the blurb itself, don't spend that much time on the size of the market, but also if you didn't exist, what is that going to cost the world? That's more what I'm paying attention to. We can always make up figures about how big the market is.
No, I totally agree with you. I think, for instance, I look at a lot of femtech companies, and a lot of the times it's kind of like nice to have. But there's one that's really standing out to me right now that's trying to tackle the problem with the U.S. healthcare system when it comes to prenatal and birthing and postpartum. It's really broken. Like I don't need to go into it right now because I could talk my head off about this, but that's a problem that needs solving, and that's what this founder is doing, and that's why it's like, oh yeah, this is just it should be so obvious. It should be so obvious for you to get why this is like going to succeed. And I feel like when it comes to consumer, none of that is necessary. None of that is solving anything in the world. But what I've seen, at least, is it's not that they're not getting funded. I feel like the bar has been raised for the companies. So the ones that are really standing out are getting funded, but it's not 2021 anymore where everyone's getting a couple $1 million just because.
Yeah. Yeah, I end up thinking about oxygen, aspirin, and jewelry in the way that stuff is purchased. So it's purchased as an oxygen if you buy it because you can't live without it. It's purchased as an aspirin if it solves a major pain point, and it's purchased as a jewelry because you buy it and it makes you feel good. And a product like your cell phone actually checks all three of those boxes. And you can move between the boxes after a purchase, but that proximity to that value creation is where I ended up spending a lot of time. To Zach's point, I totally echo that. And to Jenna, like that problem has to be validated, and there's got to be a lot of discovery around why that's a problem for specific people, and they can't solve it another way. The argument can't be spend money today to save money 12 months from now. Because if you're saving, if you're in that better, faster, cheaper market, you need to take credit for that better, cheaper, faster. If it's 12 months down the road that actually you create that better, cheaper, faster, you don't necessarily get credit for that value creation. So there's a moment in time where somebody says, "Oh, I know why I bought that. It created value for me." Or is it because of choices that I made along the way where I was using it? It's really I take credit for that value creation. So, all right, another question in here. Are the greatest inventions of the 21st century and need to be funded properly for maximum value? Where do I start?
That's a great question. Where do you start? Well, it really does have to come down to, putting it all down, first get it down. It's for me, it's really hard when I speak to founders that kind of have a very high level view on things. And they want us to kind of discuss investments based on that. You really need to really break it down. It's not just going to be a quick line and say we need investment. Where do I start? It's first understanding, what is the business, get it all down on pen and paper to begin with, and then start working on some sort of deck, some sort of presentation to explain it all, discussing the problem as we just mentioned, discussing the size of the market for sure. How will that make money? What I will say is, for me, there's only two real reasons why companies cannot raise investment. It's either they should not be raising investment at all because they're just not a good enough company, or they're not speaking to the right investors. So spend a lot of time researching who those investors are, understanding what it is they're looking for, and make sure that what you're preparing is answering that demand from them.
Yeah, I echo everything that you've said. I think the smartest founders wait the longest to fund, and that's not because they're holding out, but that's because they're taking their time to talk to people and understand the industry and then know where the good money is coming from. I think the smartest founders play hard to get with me, not because they're just saying that they're hard to get, but it's because that they know who they want and who would be the most strategic for them. So these are the folks that aren't saying yes to everybody and really having a messy cap table, but those who are talking to those industry leaders, talking to the VCs who run that industry too, and then getting to know them, and then really going after this very short list of people that you've accumulated, I think. But I mean, right now, I feel like a smart thing to do is not to raise right now too. So I'm seeing a lot of the best startups right now aren't raising because of the tough market conditions, and you're not going to get a high value right now. So if that's what you want, then you should wait probably.
Yeah, we haven't touched on this, but I think this is really important to talk about. Everybody wants a high valuation, right? And what are, it's awesome and celebrated, I think, in the news. And to my opinion, we may celebrate fundraising a little bit more than we celebrate company success and traction. What are the perils of having a wrong valuation?
Oh yeah, I could talk about this all day. Oh my goodness. Yeah. Having a high valuation really sets you up in a precarious situation, because if you say I am selling socks. I've been valued at 15 mil because my socks will do some, make your feet, I don't know, youthful and let you run very far. The problem is if I'm not able to execute and sell enough and reach the community that I need to in order to make that 15 million make sense, in the next round, you're going to face a lower valuation or a valuation that has stagnated. And that story that you tell to investors with your valuations is really, really important. If you start lower and then you're able to surpass that valuation because you sold so much between when you raised to when you're raising again, you're able to communicate that you've had this growth. Whereas if you started high and then you stagnated, or even worse, if your valuation has dropped, that signals to investors that you were in over your head when you started, you were over inflated in your value. And that just makes, you've shot yourself in the foot. And you have to dig yourself out of that hole first before you're able to get a high valuation. So once again, this goes back to raising as little as you need, building incrementally, and then having that slope up, that incremental growth.
Zach,
I'll just quickly add, we're advising to rather go with a targeted valuation and don't go in, with a firm figure and, take it or leave it. For the most part, I don't feel like VCs are taking massive chances and trying to undercut founders. For the most part, at least for the good funds out there, they're not really asking anything ridiculous. Sure, it's not what it was a year ago, but there's good reason for that. It's not because VCs are trying to be crooks. It's just things have changed. The market has changed. And so I just stress to founders, don't go in with a firm figure and telling everyone that, take it or leave it. And, we're so amazing. This is why. Be open to negotiate that, and rather take a lower valuation when you know who you want and want to bring them on board, and see that as a partnership and strategic partnership, not just capital in the bank.
Yep. All right, we've got some more questions coming in from the questions and answers. So how do you evaluate ARR in your early investment rounds?
Well, for the most part, it typically is kind of just a complete thumb suck as to what these things are before you've really launched. It just comes down to the basic unit economics and working out what does it cost, who are we going to target to sell this to. If you've got lined up a bit of a pipeline that you expect to convert, but of course you've got some figures there to work with. But at the same time, it's kind of hard. This is kind of where the corporate venturing side of things that I think was kind of part of today's topics as well is, what role does that play? Getting an early corporate partnership on board that could look to invest as well as become a customer and help to develop the product, that can help to kind of sort of whittling down what the actual cost of the product would be, what sort of sales you could expect, based on the size of that company. If we target 5 or 10 more of these, what could we start expecting to see? Again, it's a bit more research. It's not just something you can, work on straight away and go into without any, groundwork being done before.
Yeah, I definitely agree with that. I think ARR is just one tiny metric in a whole constellation of images that really we need to see in order to understand the full picture. I feel like just having a beefed up ARR doesn't really do you much if the rest of the story doesn't really line up. I think, as Zach mentioned, having a bunch of LOIs signed or a bunch of pilot programs or some pilot programs with some notable customers is just as much, capital in comparison to having a beefy ARR. So I think traction can come in a lot of forms. And I don't think that ARR is like the make or break number. We don't even have a minimum requirement for ARR.
Yeah, I'll jump in. I don't think we don't really have an ARR requirement either, but I think our analysis ends up being more around like, what's this average order contract size? You know, if you're selling $2,000 ARR versus 50,000 versus 100,000 ARR, those are completely different business models. They're also different sales cycles. And, you know, the 2,000 a month or a year ARR is probably a no touch sale versus the 100,000 ARR 3-year contract is more like a 6-month sales process where you're involving, you know, the economic buyer, the technical buyer, the end user, et cetera. So, you know, I also look at the size or the pace of the growth of that ARR. So how quickly is it climbing month over month, year over year? And then I think the third kind of flag that I try to check for is if the number of ARR contracts is low, how many are what I consider friendly clients? I think we've all seen friendly clients, right? Where you didn't really have to earn that sale. I want to talk to those guys in due diligence and understand why they purchased it. And I really don't want to hear, I've known this guy for 20 years, so I gave him a contract. I would rather hear, we found him on Google and compare them against 5 of their competitors, and they won because of X, Y, and Z, and this was our process that we evaluated them on. So moving on to Yuka's question, we are pre-seed post-revenue startup. We've doubled our revenue in 6 months with 0 marketing costs. In order to scale even more, we need more full-time developer, start marketing, which leads us to the necessity of raising funds. Is there a good networking organization, events to meet VCs, and opportunity to pitch that you recommend to participate? That sounds like all of us would be interested in that. I don't want to speak for everybody else, but I'd love to connect on that. Angel Capital Association is a great organization as well. There's usually some local angel groups that you can connect with, but I think to my point earlier, if you've spent nothing on marketing, we would have to understand what the marketing spend would mean in order for you to continue that growth, which is extremely exciting. So I guess if you haven't spent money on marketing in the past, why would spending money on marketing now continue to accelerate the growth? But Zach and Jenna?
It's a question that I often ask founders because I'm in this fundraising space and getting founders in front of more investors at somewhat of a scale, trying to figure out what that budget should be for marketing spend and things like that. Kind of look at if I wasn't fundraising, what would I be doing instead, and what sort of value and revenue could I generate doing that? So if a CEO is not doing fundraising and not doing marketing campaigns and pitch events, etc., what would they be doing instead? Typically, it's going to be more sales, and more sales means that they have more budget to do more of that. So it's a bit of a chicken and egg in that sense. But there's so many ways. I mean, sure, you can work with firms like Fundin, if I put a humble brag in there. But you know, KiwiTech, a great platform to speak to lots of founders, to speak to investors, people like ourselves that work with so many different companies. Try and get some advisors, or potentially look at getting a co-founder on board that has that experience that maybe you don't have yet. It's very much a partnership type of approach at this stage. Try and connect and network with as many people as possible. There's so many platforms to reach out to.
I'd also just add to that, definitely agree with everything that you said, is talk to other founders. Talk to other founders. The best networking you're going to do is within your industry. So if you're able to find founders, say you're new, you're able to find some founders who are already in the space that you're working in. They don't need to be your direct competitors or anything, but ask them, what groups are you part of? Who are you speaking to? I feel like, having been in this industry, it's always one person will lead me to another, which will lead me to another, which will lead me to another. And that will only give you success if it's really in that specific niche that you're occupying. And then once you know all the people who are in that area, then you're able to strike up those conversations.
We just got the hook collectively. There's not enough time left to continue the discussion, but this has been really fun. I think there was a couple of more questions that we could get to, but it will take more time. So I think now Sheen's going to come back in and open up the pitch presentations.
Thank you, Ben. Just a last question. As a company looking for investments currently, everyone wants 5K a month to be matchmaking, but no one delivers. How do we get credible investors to look at us? This is how everyone is being the gatekeepers, are making money, but never delivering. This question came from Edward.
That's interesting. We don't charge a fee to apply for our group. And I would say there's a misalignment of incentives if somebody's telling you they got to charge you a fee to pitch their group. I wouldn't respond very positively to that either.
I think from my side, because we have an interesting model at Fundin, and just the work that I do privately as a fundraising consultant, there's not a one size that fits everyone. I definitely agree with Ben. Incentives need to be aligned. Also, it's what we find is, at least from our VC partners, they don't want any broker dealers involved in a conversation. They don't want a percentage of their funds going to an introducer. So, you know, if there is going to be a spend towards getting investor ready or getting in front of new investors, you know, see that as a sales and marketing spend, not as a, you know, someone babysitting you and dealing with fundraising for you. Ideally, I'd like to see the top 1% of founders being able to do that themselves. And you know, we fill a very, very small gap where we feel is appropriate.
Yeah, I mean, I think I feel like I'm not the right person to answer this question because I don't really know too much about, I guess, these groups that charge to make those introductions. But I mean, I think from most of the founders that I've spoken with, they're able to do it either organically or, as Zach says, it's a marketing spend. You know, you pay a little bit to go present at a pitch event or some kind of demo day. And if you think that that's worth it, then it is. And I think that's really it at the bottom line. If you don't think it's worth it, then it's not, is what I'll say.
Definitely do your due diligence on whoever you're speaking to. Know who the investors are that they plan to introduce you to. You need to qualify them as well. It's not as easy as just saying, here's my money, you know, put it in front of investors, because getting the wrong investors can really backfire down the line and potentially not even result in any investment at all.
Yeah, I'll jump in too. I think qualification of the investor is really good. I would be asking questions like, well, how many checks have you written in the last 12 months? And has that changed in the last 6 months? What are the companies that you funded? And I want to talk to a CEO that you've worked with in the past. Give me your 5 companies that I could pick from, and I'll pick the one that I talk to. So, you know, I think whenever you're asked as a founder to exchange value or dollars, you have the right to ask for something in return. And that's I think with any transaction, whether it's equity or fundraising or otherwise, don't, you know, I think no question is outside of the realm of possibility of asking.
All right. Thank you, Ben, and our panelists. On behalf of everyone who joined today, we sincerely appreciate all of the wonderful insights and perspectives shared by our panelists. Thank you. Now, we would like to move to the next exciting part of the event, presentations from our high-value growth stage startups. Before I announce the startups, let's quickly go over the house rules. Each presenter will get 6 minutes to pitch, followed by 2 minutes of Q&A session with the audience. After each Q&A session, we'll conduct a poll for you to rank the presentation and seeking investor introduction with the startup. There will be a feedback form link provided in the chat feature for attendees to fill in. It helps us maintain and improve the quality of our events, so please don't forget to fill the link. With the house rules clarified, I am super excited to introduce 4 of our esteemed startup founders in order of their presentations. They are Harsha K. Rajasimha, CEO and founder at Jiva Informatics Solution; Jose Sebastian Torres Garcia, CEO and founder at Pro Investing App; Doug Freeman, CEO and founder at GroupBook; Brian Demon, CEO and co-founder at Gondola Life. First up, I would like to invite Harsha, CEO and founder at Jiva Informatics Solution. Screen is all yours, Harsha. Team, can we have Harsha? I can see Harsha.
Hi, Naushin. Thank you so much for the opportunity to present Jiva today. Hi, everyone.
Team, I think there is some problem. Can we please move Harsha to the panelists section? Sorry.
Sorry, no problem. I got back in. So I'm Harsha Rajasimha, and I'm excited to present to you a B2B SaaS platform for efficient execution of clinical trials. I'm a precision medicine data scientist by training with a PhD in genetics from Virginia Tech and about 20 years experience in the healthcare life science industry, including at NIH, FDA. And along the journey, I had lived experiences of a child with a rare disease that I fathered, as well as a younger brother who battled juvenile diabetes. And based on that, I realized much of my postdoctoral training could be applied to increase clinical trial access to patients from anywhere, but also make the whole process patient-centric and efficient, as the whole process has been less efficient over the years industry-wide. So our journey so far, having founded in 2019, we have gone through customer discovery funded by the National Science Foundation with a grant, ICOR, and initial prototyping. During the pandemic, we saw a greater need for e-consent or electronic informed consent and e-pro. We came through free pilots, paid pilots in 2021, and built a platform approach, engaging the customers that shared their problems and evolving changes during the pandemic. And so last year, we executed several projects. We now have about 12 customers with an average deal size of about $14,000 per customer. And we are expecting a 3x growth this year, although it's been a little slow in the last quarter, as the panelists were saying. We experienced a little slowdown as well. But we are seeing an exciting future ahead this year with about 5 new contract research organizations as channel partnerships signed in the last 6 months as well. So with that, clinical trials is a long and complex process, until getting this regulatory approval. That's because 9 out of 10 candidate drugs fail during the regulatory review process. And so we have a solution that can bring down the timeline of 7+ years in clinical trials to about 5 years and save 80% of the cost of clinical development. And I will show you how. Patient recruitment is the #1 problem we heard from most customers firsthand. And we know that 85% of clinical trials are delayed by 30 days or longer. That's because 1 in 4 patients decline to enroll in a clinical trial due to the travel and logistical burden, which can be avoided. And what this means is every day that's delayed during clinical trial can cost $600,000 to $8 million in lost revenue of their drug or device to the sponsor. And due to poor enrollment, as well as the patients dropping out after the clinical trial enrollment completes, about 30% drop out during the trial. And missed appointments resulting in poor data quality all result in significant inefficiencies. As we can see, there is a significant lack of diversity in clinical trials, especially as most of the trials are conducted in the United States and Europe, and the rest of the world account for less than 20% of the clinical trials. And FDA now has issued guidance and mandated more increasing diversity in clinical trials. The life science industry has become more open to adopting digital tech than ever before, and the tailwinds of the pandemic are in favor of decentralization. The e-clinical solutions market is estimated to be 16 billion, and it's growing with more than 30,000 new clinical trials starting each year. And we expect to capture about 2 to 5% of this market, especially in oncology and rare disease segments. So essentially what we saw the gap in industry with the current solutions is each of the activities that occur in a clinical trial between the investigator sites and the patients occur mostly on the left-hand side, or every visit having to be at the site. So what the industry lacked was a platform approach where all of this can be done in a flexible manner on a single modular unified platform. And that's exactly what we built to tackle the status quo, which essentially clinical trial staff log into 30 different tools to make one clinical trial successful. So we built a unified modular platform that centralizes study-specific protocols, which can be configured rather than customized. And so there is no programming, zero code, low code type approach on a B2B SaaS model. And of course, having all the regulatory and security compliances is a must, but making sure patients are engaged throughout the process before recruitment, during, and after recruitment is what we, so we are differentiated in having a starting base price because we are modular platform, but also focused on small and mid-sized sponsors and CROs, and the ability to manage protocol complexity and amendments in a single platform. So our pricing model involves a one-time setup fee and an annual subscription model, which is based on per user per year. So we are in the early stage of revenues and growth, so we expect to break even in the next 12 months. We are seeing a significant validation of our platform with our early customers, and we are seeing a growing number of CROs signing up as a distributor or a value-added reseller of our platform. So we expect a exit, most likely exit through merger and acquisition in the next 2 to 4 years. And, this year, we are in the United States and Asia Pac region with our current customers, and we expect to scale to Latin America and Europe in the next year, and other rest of the world in 2025. And as we accumulate more data, we will have AI, ML, and we have a winning team and a leadership team in place to execute this vision, and an advisory board. And we are currently seeking a seed series round of 700,000, of which 350 has been closed, and we are seeking for the remaining 350. That will help us execute and achieve our break-even point of achieving 500,000 in ARR. Thank you for listening. Happy to answer any questions.
Thank you, Harsha. That was a great presentation. I will now request our panelists to share the feedback or any question they might have for our founder.
If I could ask a question, stop my video. There we go. There we go. Thank you very much for sharing that, Harsha. So within the medical space, of course, you have mentioned that the platform does comply with all the regulatory requirements. In terms of what that process looks like, because usually there's lots of different R&D specialists involved, a lot of advisors, a lot of consultants involved in that process to get the the trial underway. How have they adopted using this? Does this integrate quite well with kind of traditional processes, or are they required to completely take on a new approach? What's the feedback been from their side?
Yeah, absolutely fits well within their existing workflows, and with not requiring significant changes on our customer and the users side, except that they can access it from any of their existing devices and so on. So from a regulatory point of view, it allows them significant flexibility, although we are currently in phase 1 and phase 2 clinical trials. When we get to phase 3, that they tend to be more global. We are in single country trials right now, all in US or all in India. And so as we get to phase 3, we may need to adhere to multiple regulatory frameworks in Europe and Africa and other countries as well. But GDPR, HIPAA, SOC 2, and working our way towards ISO standards is basically what we have taken action towards. But as a requirement point of view, 21 CFR Part 11 from FDA is the highest standards of regulatory requirements that we comply with. And Europe has its Annex 11, which is a counterpart of that. So those we had third-party audits over the last 2 years in a row. We had third-party auditors verify that we comply with those regulations.
Does that mean that that's also a source of generating leads as well, apart from just the startups that could be, or pharma companies that could be clients? Could those consultants and advisors and various R&D specialists, could they also be clients that use this to improve how they provide their services to customers?
They absolutely could be, although we have not had pursued that angle as our primary focus, and it hasn't resulted in any significant success in that direction. But I think contract research organizations that small to mid-sized, that have 5 to 50 clinical trials per year and do not have a technology platform in-house, those are our ideal value reseller and partner agreements. We have 15 of those, and about 7 of them have resulted in RFP proposals where we have provided pricing and quotations and proposals for, and 1 of them has resulted in a success. So we are going direct to our ICP, which is emerging and mid-market biopharmaceutical companies that are running phase 2 pivotal clinical trials at the moment. And our goal is to get to that phase 3 global trial by next year.
Great. Thank you, Harsha.
Harsha, thank you. I have 2 questions. I apologize if I missed this, but one is around the team. Who all is on your team, and what are the skill sets? And then just a quick follow-up. What are you think are the gaps in this team?
So we have Dr. Emmanuel Gorosky, who is the medical director, who is an MD and is principal investigator, who has run multiple clinical trials as our fractional medical director. Chris Daly, who is our fractional chief revenue officer, is optimizing our sales process, lead generation, how we define ICP, and getting that scalable, repeatable sales process in place. And Chandan is our full-time product manager from a top engineering college in biotechnology and 15 years in building cloud-native applications in biotechnology. And Dory is our compliance and regulatory officer, who does day in and day out verifying compliance with FDA and EMA and other regulatory requirements. We have filled a lot of these gaps with our partners, including KiwiTech, who have built, provided the software engineering resources in a cost-effective way, and additional like Leica for compliance and for SOC 2 Type 2 and others. We have built on AWS as our SaaS platform, etc. So we
and
have.
Then, sorry, the second question was the target customer. Are you selling to other life science startups, or are you selling to large pharma?
We have initially we are selling to emerging and mid-market, small to mid-size biopharmaceutical companies that may have done their Series A or B, getting to their next milestone of executing their phase 1, phase 2 trials. So then they can partner with the larger pharma for a global phase 3 trial. So yeah.
I don't know how much time is left now. Sheen, how much time do we have?
So due to time constraint, I would suggest we cannot ask more questions.
Okay.
Thank you. Thank you, panelists. Thank you, Harsha, for amazing presentation. Now we'd have the poll up on the screen to share, to rate the presentation. And if any investor wants an individual introduction with Harsha, they can click yes on the poll. I would like to pull your attention back on the screen for our Startup Workshop 808 series on May 16th, and we hope to see you there. Now I would like Karishma to take over from here. Over to you, Karishma.
Thank you, Nosheen. That was a great start to the event by Harsha. Continuing the trend, I'd now like to invite Jose Sebastian Torres Garcia, CEO and co-founder at Pro Investing App. Screen is all yours, Jose. Good luck.
Hello, everyone. Thank you for having me today here. Today, I'm going to talk to you about the situation of a lot of Latin Americans and emerging countries people. In Latam, just 32% of the people have financial literacy, and that generates that just 10% of the people save and invest money actively in the stock market. And also 62% of the people don't even have a pension fund. And when they try to invest in the market, there are also a lot of scams that hurt the people. The problem for us is huge. An upper middle class worker in Latam could make around $30,000 per year. But if they invest in the retirement fund, after 30 years of investing money, they could have a pension as low as $4,000 per year, even though they had in a past for Latin American standards a good salary. So we are creating a solution that help people to solve those problems, both of the problems that I mentioned in the past, education and a financial platform in which they could invest without higher fees. So from the educational side, we are going to launch next week. And this educational program, a platform that you can see here, is going to be available in Play Store. We already have more than 1,000 invitations and people that is interested in download the app. And next year we want to launch the financial side of the app. Basically, we need to be registered in the US as a hedge fund to do that. So our value proposition is charge the client just 1% fee and 1% success fee. In Latin American investment funds, charge between 6 and 7%, which is 400% higher than the average fee charge in a developed country. We use artificial intelligence to optimize our portfolios. On the other hand, the traditional funds have a lot of conflict of interest. We want that the clients select us because they are educated and they know that we are better than the rest. And also we provide insurance for the inside our platform. So this gives us a competitive advantage, and Latin American market is huge. We estimate the market is more than $55 billion. And the fintech sector is the one that is growing the most right now in Latam, even though we are facing a recession. In the meantime, we also plan to raise the money of our clients via stable coins that is going to facilitate us the process and the regulation process instead of doing that regulatory process in every single country. We can raise money via stable coins and then invest the money in a diversified portfolio in the US. So this is our plan. This is our idea. And my question is if you want to be part of this team. Thank you for your time, and I appreciate it.
Thank you, Jose. That was a great presentation. I now request our panelists to share their feedback or any question they would have for our founder.
I would love to hear a little bit more about what kind of traction you have, whether it be in user engagement, whether it be where you're at in the R&D. What does that look like right now?
We start as an advisor right now in the company. We have almost $1 million under advice. But right now we are not raising money directly from the app because it's not legal. So about Traction, we have more than 1,000 people that want to download the educational side of the app, and we have around $1 million under management, but via an advisor agreement. So we don't raise directly the money of our clients in this stage of the company.
Shall I go next? Yeah, I'll go next. So two things. So you mentioned there that it's not yet legal for you to generate revenues from that. So there's obviously a license that you're needing. What's the pathway for that? Will the investment that you're seeking now be used to secure that, or is there what's the process to become legal and actually start generating revenues? And how long will that?
Basically, I as an individual, as a company, we are already licensed in the United States. I hold the FINRA Series 3 license that allow me to trade stocks, mainly futures in the US. But in order to, but that license gives you the right to give advising, but not to raise money. In order to raise money, you have to build a hedge fund, and that is going to cost us around $50,000. With $50,000, we can create the legal structure to create the hedge fund in Delaware, in the United States. And based on that hedge fund, now we can receive money in a legal way. Yeah, basically that is the process.
The only other feedback I would have is just to make sure that your pitch deck can kind of narrate itself. The trouble that we kind of find with pitch decks a lot these days is that founders are hoping to be able to narrate, the pitch deck for investors, but sometimes they don't even get to that point when sending a pitch deck or showing initial information. So information like a bit of a financial plan, although this is kind of pre-revenue, a bit of a financial plan, what do you expect to be reaching in the next 12 to 24 months, etc. How much you're wanting to raise, that would also be good to know.
Okay, I'm going to show that right now. So basically, these are our projections that are based in assets under management. As you see, the market is huge. If we in 5 years we have just a tiny percentage of the market, by 2025 we could have around $300,000 under management. We estimate that our clients are going to cost around $140 each, and each client is going to generate to the firm around $300, based on the information that we have gathered from other startups. Those are the numbers. Could you remember the other question, please?
Oh, how much you're looking to raise now?
Right now, $200,000 for 10% of the company.
Great, thank you. That's all from my side.
Thank you. Thank you.
Thank you.
Oh,
Go ahead.
we have time. Jose, I come from a banking background, and financial literacy is something that is just a widespread problem. Like I love this problem that you're working on, but my question, I think, is a little bit more simple, is why is it that saving for the future is something that's just so much of a barrier for so many people? And how do you position the company for winning that piece of the problem that's being solved?
Yeah, basically, education. We believe that education is the key that make the people understand that they have to save, especially for retirement stages, and also select a good way to save money, because right now, yeah, as you see at the first numbers, in Latam, 62% of the people don't even have a pension fund, and when they select a private hedge fund or private pension fund, the commission that they charge are exuberant. So at the end of the day, even though if you have a good salary for Latin American standards, your retirement is going to be like the minimum wage. So it's a problem that is hurting a lot of Latin Americans, that they have to live with a minimum, even though during all their life they could have a good life, taking into account the currency parity. $30,000 is a very good salary back in Latin America. So I believe that's why we initiate with education, because we believe that is the key. Actually, we are going to give the educational side for free. It's going to be free because we want to gain the trust of our potential clients. And once they are educated, they are going to start investing. That is something that have worked for us in the past. The million that we have under management, basically the vast majority, they were our students, and they decide to give us our money to invest in the long run.
Thank you.
Thank you for your question.
Thank you to all the panelists for the feedback and for the responses. Poll is up on screen for our audience members to rate the presentation. And if you'd like an individual introduction with Jose, click on yes. Hope you're done. There's another feedback link in the chat box. Please make sure you fill it. Your feedback is really important to us to maintain and enhance the quality of our events. Next up, we have Doug Freeman, CEO and founder at Group Book. Hi, Doug. Are you there?
Yes, how's it going, everybody? Good afternoon. Thanks, Zach and Ben and everybody, the panelists. It was a great talk. I appreciate you having me on here, and excited to go through the presentation here today.
We're also excited. Screen is all yours, Doug. Good luck.
Thank you. All righty. So good afternoon, everybody. And my name is Doug Freeman, and my platform is Group Book. And a little bit about me will give you a little bit more insight into who we are, what we do, and what problem we're really solving. And my background personally was in baseball. I had a chance to play baseball in college, played professionally, coached college baseball, and then got an opportunity to work as owned a franchise as a baseball scouting service. And part of that process in running a baseball scouting service are events like showcases and tournaments. And tournaments especially are where we're bringing in 30, 50, 100, 200 teams from all over the country into a city. And part of the revenue that's generated is from two sources. One, grant dollars for economic impact from that city or county, and two, from a profit share with a hotel accommodations partner. So as I was going through this process, we found that we got more complaints about our hotel partner than we did compliments. So went at that point in time to be able to see what this problem was and try to go out on our own and take care of the hotels individually. At that point in time, we became a certified travel agency. We're an independent travel agency, not under any consortia. We are completely independent. And we're working with some of the current solutions that were out there whether that was, some white label services and different options to be able to source the hotels and offer them to our customers ourselves. And when we were able to do that, we really found that there was a number of different issues there. One, the ability to monetize these bookings was difficult because the user interface was difficult. When people were getting on there and they're required to stay with this particular hotels, you'd like it to be an easy experience, and it really wasn't. That and the prices were static. There was no ability to change based on demand. There was no way to flex it and really optimize the revenue based on the places that people really wanted to stay. So what did we decide to do? All right, so we decided to build our own platform. At this point in time, we built a platform that operates on Amadeus, which is called one of the global distribution systems where hotels operate on nationwide. And that's our current process right now as we look to build out the proof of concept with our current clients that we have currently that we've been working with for several years. So what do we do differently than what some of the competitors do? Well, the dynamic pricing, as I mentioned, is a big piece of what we found was extremely optimal for both the event operators and the hotels, as well as the customers. What this does is allows us to flex the price based on the demand and optimize the revenue, not only for group book, but for the event owners and the hotels as well. So the guest is guaranteed the best rate and everybody else is able to optimize that demand in those areas. And then the other option is providing really clean, simple customer interface that makes it easy to book and easy to communicate, because the big feedback we had was how poor the customer service was in these large group travel companies and just really not able to modify or change any sort of reservations. And while our focus is in sports, and that's our initial focus here with the group platform, we really were able to find a bunch of different avenues of this. But the sports industry itself is really unique and how it can stand alone in this particular space. $8.4 billion in 2021 alone was spent solely on lodging. And this is tracked $8.4 billion, tracked economic impact spend. So this is reported by companies like myself to the counties, that's reported to the state, that's reported nationally, that we are able to attack and optimize in a better way to be able to optimize our own revenue. And group and global, as you can see, huge, massive industry overall. Some of the other items that we're looking to attack, we really want to optimize our sports outreach, onboarding new event operators and events, but some interesting contracts we're in the course of operating with and in the course of negotiating. Large scale wedding websites. If you've ever been to a wedding, trying to negotiate or manage their block is one of the biggest headaches. Same thing with conferences and festivals, or even if you just have a large family. When we travel ourselves, between me, my family, our wife, we're 8, 10, 12 rooms right there. And it becomes really a difficult thing to navigate, because our platform, what we were able to do is to be able to set out to give people the ability to easily request blocks at multiple properties without having to call several sales directors, wait to hear back from them, email back and forth. You send a request in and everything is handled on our end. And we're really excited to announce by the end of June in 2022, we'll be launching our own independent vacation rental portion of the platform. And we'll be the only sports tourism, the only sports accommodations platform that will profit share on vacation rentals in the entire US. So what have we been able to do? Well, last year with our clients that we have always worked with, a variety of different clients, Prep Baseball Report, Play Treasure Coast, and Texas Premier, we did 12,350 room nights. Already in Q1, we've done almost 14,000 room nights, and we're projecting almost 40,000 room nights this year. Most of that is with our current clients continuing to grow. So really being able to optimize with those clients and then being able to continue to optimize our revenue. A couple of the other different avenues of revenue are experiences and events that we're able to do, and the state of play model, which requires the tournaments to be able to book with us and to be able to play. We're really striving for tech independence, which will mean directly connecting with the hotel and ultimately being our own independent booking platform, not relying on any other service, which will then optimize the revenue, profitability, and different items. Our current users love us. Our current customers love us. We're really doing a strategic, slow, and monitored approach. This is my background. We're really looking for $1.2 to $2 million of strategic funding to be able to optimize our team. I've done this all independently really be able to build out an A1 team to target sales and partnerships, hotels, vacation rentals, and then finalize phase 2 and 3 of our development platform, which is the group and all of those things. So really excited. Thanks everybody for the time, and look forward to have some questions.
Thank you for this amazing presentation, Doug. I now request our panelists to share the feedback or anything they have for Doug.
Doug, can you walk us through that customer acquisition process? How do you, there's that moment that the event organizer is kind of looking for a solution. And I imagine that you're kind of competing with other travel agencies that are better funded and can pay to be at the top of the SEO search, right? So how do you?
Yeah, no. Actually, so there's no SEO search involved whatsoever. There's a very specific niche within the sports tourism world where you have 3 to 4 platforms that operate independently, and the model exists solely on profit share. So the people that are at the top of the funnel are deciding who they believe is going to get the most pickup and what platform is going to generate that type of revenue. So for us, it's negotiating the ability to have the highest rev share profit margin at the top of the the top of the chain, to be able to say, hey, this is why we're a better platform because of A, B, and C. And we're able to actually use our previous numbers because we've operated on those previous platforms to show that we're like 15 to 20% higher in revenue for those event operators than anybody else in the industry right now.
So you're selling to the event organizer then as the target customer?
Initially, yeah, our event organizer sports market is our initial market share kind of capture. And then we're going to use that as we continue to kind of check off 5 to 10 high level operators, it gives us the ability to generate, several 100,000 room nights. That is a snowball effect to give us the ability to leverage larger term partnerships with the Marriotts and Hiltons to be able to continue to compete in that direct to consumer group space because we'll already have the rates integrated into our site.
So are they putting out RFPs that you put quotes on, or how do you compete for that? What's that process look like?
So the process of acquisition is essentially one, referrals. We've gotten a lot of referrals from current customers and clients have referred us to other event owners and operators because they're always looking for a new solution. Every year it seems like they're unhappy, and we haven't lost one yet. So we've been very strategic as to who we brought on, and everyone that's come on board with us has stayed on for the entirety of the relationship. Most of it, that's part of what the fundraising is for, is to build out a strategic strategy based on my experience, really set a really good sales structure to reach out to the decision makers in every avenue of each sport. The baseballs, lacrosse, hockey, every single one has event operators that do, anywhere from 10,000 to 100,000 room nights.
Thank you.
Do you think you could take us through your margin story?
What's that? Sorry.
Do you think you could take us through your margins? Yeah.
Yeah. So our average daily room night is $256, which is almost 30% higher than the general average daily room night in the US, which is, anywhere from 150 to 175. And what we're able to do, depending on area. So if it's the first time that we're operating in a city, brand new city, first time that we're working with a hotel partner, our margins tend to be after our profit share with a event owner, which is our marketing spend. We don't have a marketing spend because they are directly putting their consumers to us. It's about $10 per room per night. After a multi-years, after 2 to 3 years in a particular area, that goes from anywhere from $15 to $20 per room per night. So it continues to increase as the volume increases because our pricing model is able to be more refined in terms of where we understand the needs are. So it's profitable from day one as well, because that was our ability to be able to monitor. Okay, we know what they're going to require. We know what our staffing needs are, and as we build out the platform, it gives you the ability to scale it really easily with low overhead.
Just a very quick question from my side. Defensibility. To Ben's point before, there's a lot of large players in this space. The amount of revenues you're making right now, I would imagine you're starting to be noticed by them, potentially what you're doing and what this may look like down the line. How easy would it be for one of these larger players to either acquire you down the line or even just do what you're doing but with that spend that they have to their available to them.
Yeah, well, I mean, acquisition would be based on how much they're willing to pay and what the value is. But ultimately, the model has existed for some time. The Expedias and Bookings and the large players that you're familiar with have never played in this space. It's a space that they would have to completely spin up, and they would have to completely build new relationships. And it's a completely different business model than where they operate. Right now, they're not taking on any agreements. They're singles. They're booking anything less than 9 rooms. And that's the standard process in hotel booking. So the ones that you probably come to front of mind aren't truly the competitors in the space. And they are more the engines for some of the competitors in the space. Their white label GDS or their platforms provide the ability to process some of these bookings or discounts. A company like Hotel Planner uses Expedia's API, and they are one of the ones who are focused in the group space with a really poor user interface because they are having to build off of what Expedia provides them. So the moat is really high because to build it out independently, you have to tie into something else. We were able to kind of replicate it and create our own dynamic model to where as we continue to get hotels on, they will be directly tied into our platform, which will create an enormous strategic advantage. Plus the deals tend to be 3 to 5 year mutually exclusive contracts.
Right. And just last question, the revenues you're doing right now, are they fully converted over to the tech platform now? Is there still an element of service? Because it sounds like there was existing clients that have moved over
Yes.
or continued rather. Is that fully migrated now?
Correct. Yeah, fully migrated as of September, October of last year. Had everybody onto this platform. So the numbers this year to date, are 100% on our platform.
Perfect. Thank you.
Thank you, Ben. And thank you for all the responses, Doug. For all our audience members, there's a poll up on screen. Use that to rate the presentation and click on yes if you would like an individual introduction with Doug. Once you're done, can I have your attention back on screen? We have recently introduced a referral program at KiwiTech. This program basically rewards anyone who contributes to fruitful introduction to our company. So if you know someone looking for tech development support to scale, join our referral program by following the steps on the screen, or you could also visit our website. Our purpose with this program is simply to reward people for their trust in us. With that, let's move to the next and the last presentation of the event. Brian Dumont, CEO and co-founder at Gondola Life. Hey, Brian, all set? Are you there? Can you unmute yourself, Brian?
Hi there, thank you. Okay, we are ready. Welcome to Gondola Life. My name is Brian Dumont. I'm the CEO and co-founder. We are creating the infinite AI life insurance agent and pairing that with our hybrid agency. Why are we doing this? Well, let's move to the next slide, please. Millennials and even Gen X want to buy insurance online like every other product. However, life insurance, especially permanent product that is high premium, is very complex and really requires the expertise of an agent to help fit that product to the specific financial situation of each person. Yet when people go online, there is no agent and certainly no AI agent to actually help them do that. That is why Gondola is creating the first ever AI agent we are calling Gandhi, and we are pairing that with our hybrid agency. Gandhi will use ChatGPT and an overlay to guide clients through the entire education, sales, and service process. Gandhi, which is short for Gondola, will interact with clients with an animated avatar and talk and text and help guide clients through the process. And if people wish to speak to a live licensed agent, we will have them available as well to help guide them through our 100+ carriers and products. Two examples of how Gandhi would work. These are completely unique to Gondola. There is not another insurance site out there that has anything quite like this. Suppose somebody came to us and said, oh, I'd like $1 million of coverage, which you can see on the red line. Gandhi would respond and say, you know, you could qualify for up to $4.5 million of protection to protect your $7.1 million of income that you will earn. Right now, you've only asked for $1 million. Is that really what you want? And that type of challenge coming from Gandhi, we believe, will move people in the direction of more coverage and, of course, more revenue for Gondola. Another example, we look at permanent life insurance as what we call a safe tank, a safe place where people can accumulate tax-free dollars for retirement. Gandhi would say to them, based on the conversation we've just had, it's clear that you don't yet have a safe tank. When you get to retirement, how much of your money would you like in a safe tank versus your investment tank that you have today? They might say, I'd like a third. And Gandhi would say, great, let me show you how to get a policy started today on building your safe tank. Here is the Gondola ecosystem. It reads from left to right, beginning with the way we will drive traffic through algorithms, scraping and funneling and retargeting, drive that traffic to our site, have multiple carriers and third parties that we exchange information for quotes and applications and servicing. And of course, Gandhi itself, which will collect a tremendous amount of data. That data we will be able to harvest and analyze and sell back to the insurance industry at very high premiums. Those premiums, we believe, will actually be significantly more in revenue to Gondola than the actual insurance policies themselves. One more quick thing on this slide, and that is that we believe that the majority of cases, once Gandhi is actually running well, will go through without actually human touch at all, meaning Gandhi will handle everything. There will always be some that will need direct live agents, and we will have those available. As you can see, our estimate is 10%. Who are the target markets? Millennials and Gen X. And if you move to the next slide, the reason that this is such an important group right now is that they are at their highest level of awareness of mortality, thanks to the pandemic, as well as their desire to own insurance. And that is according to LIMRA and the research agencies. How does Gondola compare to our competitors? Both in terms of the sophistication of our AI, as well as the openness of our marketplace, having Gandhi help direct people to the appropriate policy for them. Different than every other insurance site out there. Significantly different on both of those axes. Here's an example of average premiums that Gondola will collect on different types of policies. All of the competitors you just saw are selling term life at $9.45 an average premium. Gondola is going to specialize in permanent life insurance at, you can see, more than 8 times as much in terms of premium. One more thing, data analytics. 38x is what we anticipate the average addition to our cap value will be. Key milestones, we have just released our prototype. We are raising our seed of $1 million right now. And we expect the initial launch, our MVP of Gandhi, later this year. You can see here from our numbers that we expect to be profitable by as early as year 3. That is, again, because in part, not just the life insurance or other insurance sales, but because of the data sales, which you can see is a very large number there. Again, we are raising $1 million. That is available at a discount for investors who want to get in before the addition of the cap data sales hits our cap table. We will use that to create Gandhi, to train it, and to hire agents to work with it and launch later this year. This is our team. My brother and I are co-founders. We've been in the business, insurance business and financial services for over 20 years. Kiwi and our advisory board, all significant players in these industries. That is it. Gandhi will be defining insurance distribution for the next generation. we're happy to have you all here today, and I look forward to your questions. Thanks for your attention.
Thank you, Brian. Now I request our panelists to share the feedback or any question they have for Brian.
Hey, Brian, thank you. I could tell that you spent a kind of a career in this market, so appreciate your insights here.
My pleasure.
What's the real reason why life insurance isn't purchased more often? I mean, what's the barrier to that, and how does Gandhi solve that problem?
That's a great question. There are a couple of reasons. Number one, if you look at what's available online right now, there aren't that many players yet. There's just a handful. I would say about 8 to 12, really, if you look at it. And all of those are selling what's called term insurance, which is low premium, sort of easy, not a lot of explanation needed. And that actually is not where the majority of the money is in the industry. There is money in that. But actually, the majority of advisors have always made their money. I've made money on permanent insurance, which includes a much higher premium, cash value, and stays with the person for their entire life. It's really a planning tool that is underutilized because of the complexity of it. The second reason is that those sites really don't understand how to sell insurance. The insurance companies themselves don't understand how to sell insurance. One of the things I didn't mention is that Gandhi is going to be trained with one of the most successful life insurance sales programs in America, founded by a friend of mine named Don Blanton. Spent over 30 years in the development. It is both a philosophy as well as a software. We're going to bring that to Gandhi. The two slides that I showed you with those little tanks, the safe tank and the income tank, those come from Circle of Wealth. There isn't an explanation like that out there in the industry anywhere else. And it's quick and it's intuitive, and people, once they understand the value of what they're buying, they want to buy it. Hope that answers your question.
I could dig in a little bit more. I want to give others a chance.
Sure.
I guess I'll go next. A question around the ChatGPT feature. So obviously right now, ChatGPT is great. Everyone's loving it. It's very useful. I use it on a day-to-day basis. As a financial advisor, as a life insurance policy advisor, permanent insurance advisor, what limitations do you have? Because I would imagine it can't really advise and execute on an investment like this, regardless of the size of it. I would imagine that still needs to be regulated or monitored in some way or fashion. Can you just talk about that, please?
Yeah, that's a great question, Zach. So you are correct, of course. Gandhi and AI can never be licensed, at least at this point in the legal structure in America, right? So if Gandhi makes a recommendation, that has to really, as far as we know, and we're still working out the details on this on legal, has to be approved or seen in some respects by a live licensed agent who is then able to actually make the sale. Now, Gondola is licensed already in 2 states, and we'll have reciprocal licenses as soon as we wish to have them. We just have to pay the fees, but we're starting in 2 states to start with. And so there is a regulatory and compliance side of this that we do have to pay attention to. But we do believe that there are some ways to, let's say, work within those constraints.
Great, thank you.
Yeah.
I think one last quick question here. How are you thinking about marketing, I guess, in the past and moving forward?
Okay, great question. So part of it is technology and part of it is the message, right? So in terms of technology, the algorithms and the particular ways of scraping and basically driving traffic that is going to other insurance and interested areas to Gondola. Those are particular ways. I'm not the expert technology person to explain the details of how that works, but I know it works. It's been done in a number of industries, and our partner, which is an Australian company, actually has perfected a lot of algorithms to do just that. Secondly, the message. So the message in Circle of Wealth, which again is our particular proprietary messaging from the life insurance sales system I talked about, talks about insurance as what we call wants-based product, not a needs-based product. Every single site you'll go out there, Policy Genius, Lemonade, et cetera, has the messaging that how much do you need? Oh, well, if I need something, how much do I want to pay for it? As little as possible, right? What if I want it? Like I want the shiny new car. Price suddenly is not such an object, is it? When people understand the value of life insurance, particularly permanent product that we're going to specialize in, suddenly it's not about the dollars and cents. It's about the fact that I want access to my money, tax-free advantages, a safe tank, etc. And that comes through in the advertising as well. We don't have to advertise insurance. We advertise what people want, you see? Okay, that's kind of a nutshell. Hope that helps.
Thank you.
Sure.
Thank you to all the presenters, and thank you to Brian for all the responses. The
My
poll is
pleasure.
up on screen for our audience members. Rate the presentation and also click on yes if you would like an individual introduction with Brian. And with that, let's wrap this event by paying due credits first. Thank you so much to all our panelists, all our startup presenters, and the guests who registered for the venture capital panel. We greatly appreciate your time and effort. I hope that the event was well worth your time and you had as much fun attending it as we are bringing it to you. We host such startup empowering and investor insider events on a weekly basis. So if you wish to keep a track on the latest, do register for them. You have everything for upcoming events